Let's begin by understanding what a stablecoin is. As the name suggests, a stablecoin is a stable cryptocurrency. Unlike Bitcoin, which can experience extreme price volatility, stablecoins are digital assets pegged 1:1 to real-world currencies like the US dollar. These are not just digital currencies, they have become tools to sustain US dollar dominance in global finance. There are three main types of stablecoins. First, fiat-backed. This model involves holding real fiat money, like US dollars, in reserve and issuing an equivalent amount of tokens. Second, commodity-backed or crypto-backed. These use gold, government bonds, or cryptocurrencies as collateral. Third, algorithmic stablecoins. However, as seen in the Terra Luna crash, this model carries high risk. Today, our focus is on dollar-pegged stablecoins, particularly USDT and USDC. USDT is issued by Tether and holds over 60% market share. However, it's not without controversy. Tether has been criticized for lack of transparency about what backs its tokens and has previously been found under-collateralized. While Tether now includes U.S. Treasury bonds among its reserves, concerns remain about the absence of full public audits. In contrast, USDC is issued by the U.S. fintech firm Circle and is subject to monthly public audits conducted by external firms. USDC is known for its transparency and regulatory alignment, making it more trusted among institutional investors. In essence, USDT emphasizes liquidity and global accessibility, while USDC focuses on transparency and regulatory integration. Now, let's turn to recent moves by the U.S. government. A new bill called the Genius Act recently passed the U.S. Senate. Its goal is not to suppress stablecoins but to legally define and regulate payment stablecoins within the financial system. The key points of the Genius Act include: only USD-pegged payment stablecoins will be recognized, issuers must maintain asset reserves, undergo regular audits, and comply with AML, anti-money laundering, regulations. Issuers must be federally or state-authorized institutions and submit to post-issuance oversight. Why now? The answer lies in the U.S. strategy to maintain dollar hegemony. China is promoting its digital yuan across Asia, the Middle East, and Africa. Europe is accelerating its digital euro project. Amid global competition for digital currency leadership, the U.S. has chosen a different path. Rather than issuing a central bank digital currency, CBDC, it is supporting privately issued stablecoins. There are two main reasons for this approach. First, Americans highly value financial privacy. CBDCs could allow governments to track all transactions, raising fears of a surveillance state. Second, the infrastructure for private stablecoins like USDT and USDC is already well developed. From a strategic standpoint, empowering the private sector offers greater flexibility and speed. CBDCs may conflict with American values of liberty and privacy. That's why President Trump issued Executive Order 14178 in January 2025. This order bans the development of CBDCs and instead promotes the regulated use of legitimate stablecoins. In other words, while a government-issued digital dollar is off the table, privately issued dollar-pegged digital assets are welcome. The order focuses on three goals: easing digital asset regulation, protecting financial privacy, and encouraging innovation. At its core is the idea of using stablecoins as a tool for digital dollar supremacy. The government will regulate, not issue, digital dollars, letting private firms handle innovation while ensuring compliance. Genius Act and the Executive Order are complementary steps in this broader strategy. This strategy also affects the U.S. Treasury market. The Genius Act requires issuers to hold a portion of their reserves in U.S. Treasuries. As more stablecoins are issued, demand for short-term treasuries increases. This mechanism supports U.S. debt markets and reinforces global trust in the dollar. Still, there are challenges. Due to its opaque reserve structure and lack of consistent auditing, USDT is seen as potentially incompatible with Genius Act standards. This may lead to a decline in institutional adoption in the U.S. market. On the other hand, Circle, which issues USDC, is positioned to benefit. Circle has applied to establish a trust bank under OCC regulation and is aligning USDC with regulatory expectations. This move is likely to attract more institutional investors and expand USDC's market share. So where is this all heading? The US is transitioning from 20th century petrodollar dominance to 21st century digital dollar supremacy. In the past, the dollar ruled global trade through oil. Now, the US aims to retain that dominance via stablecoins and digital assets. This is not just about money, it's about securing leadership in the global financial system. And stablecoins may be the most practical tool to do it. In conclusion, stablecoins are more than digital tokens, they're at the center of a new global currency order. Trump's policies, the Genius Act, and private sector initiatives all point toward a future where the dollar remains dominant, but in a new, digital form. Who do you think will lead the future of digital dollars? Will it be USDT, with its liquidity, or USDC, with its transparency? Share your thoughts in the comments.